All right, let's dive right in. Today, we're going to peel back the curtain on the largest financial market on the entire planet, a world that for a lot of people is a total mystery, Forex trading. We're going to break down what it is, how it actually works, and why it's moving trillions of dollars every single day. Let's kick things off with a number that's, well, it's pretty hard to wrap your head around. To really get Forex, you first have to appreciate its unbelievable, almost mind-boggling scale. So, check this out. Over $3 trillion. Now, get this, that's not the market's total worth or what it does in a year. Nope, that is the amount of money traded every single day. To really put that into perspective, I mean, the Forex market just absolutely dwarfs the daily volume of all the world's stock markets combined. It's not even close. We're talking about a completely different universe of money. And, because of that insane amount of volume, this market is open for business 24 hours a day, pretty much 6 days a week. It literally follows the sun around the globe, hopping from London to New York to Tokyo and right back again. Okay, so to get around in this world, you've got to speak the language, right? So let's break down some of the absolute must-know core concepts that you'll see everywhere. So here's the first big thing to get. Everything in Forex is done in pairs. You're never just buying, say, euros. You're actually buying euros by selling US dollars at the exact same time. It's always a two-way street, which is why you always see currencies quoted like this. Now, while you could trade tons of different currency pairs, most of the real action, we're talking something like 75% of all trades, is packed into just a handful of what we call the majors. And you'll probably notice a common theme here. The US dollar is almost always in the mix. It's kind of the anchor of the whole system. Okay, so how do we measure profits and losses? Well, it's in these super tiny little increments called pips. So for example, if the USD/JPY pair moves from 120.50 to 120.51, boom, that's a 1 pip move. It's a fraction of a penny. And that probably has you wondering, how on earth does anyone make serious money from that? Well, one cool thing about Forex is that unlike stocks, you can just as easily bet on a currency's value going down as you can on it going up. If you think the euro is about to get stronger against the dollar, you go long. But if you think it's going to get weaker, you go short. It's that simple. So, with trillions of dollars zipping around the globe every day, you gotta ask, who's actually doing all this trading? The answer is probably not who you think. This market is absolutely dominated by the big guns. We're talking massive commercial and investment banks, central banks, giant corporations. They're the ones moving the real money. And individual traders, people like us, we're known as retail traders. And we make up that tiny little slice right there. Yep, only about 2% of the whole shebang. Okay, so if pips are tiny and retail traders are just a small fraction of the market, how is it possible to make any significant cash? Well, the answer lies in one of finance's most powerful and, let's be honest, most dangerous tools: leverage. Think of leverage as a loan from your broker. It lets you punch way above your weight. So with 100-to-1 leverage, for every single dollar you put on the line, you get to control $100 in the market. As you can imagine, it magnifies everything. Let's really see how this plays out. Let's just say the currency pair you're trading moves up by a tiny 1%. Doesn't sound like much at all, does it? But just wait. With leverage, that little move can become a huge deal. So without leverage, a 1% move up means you make a 1% profit. Pretty straightforward. But with that 100-to-1 leverage we talked about, that exact same 1% price move suddenly becomes a 100% profit on your investment. You just doubled your money. Just like that. But, and this is a huge but, what happens if that currency moves down 1% instead? This is where you see the other edge of that sword, and it is razor sharp. With that same leverage, a 1% move against you completely wipes you out. 100% of your capital is gone. Poof. And this right here is why leverage has to be treated with some serious, serious respect. It can make you a lot of money, for sure, but it can also erase your account in the blink of an eye. So what's actually causing these prices to jump up and down to begin with? Well, when you boil it all down, a currency's value is really a reflection of how healthy and stable people think its home country's economy is. So traders are just constantly scanning a flood of information, trying to get a read on which way a currency might be headed. They're watching every move central banks make on interest rates. They're tearing apart economic reports on things like GDP and jobs. Even political news matters. They're always trying to figure out which economies are on the upswing and which are slowing down, because one strong report can send a currency's value through the roof. And there you have it, a market that's almost too big to comprehend, that never sleeps, and that gives you the power to turn tiny movements into massive gains, or, of course, massive losses. I think the one thing to really take away from all this is that duality, that incredible balance between opportunity and risk. Understanding that is absolutely everything.